Hey folks, it's Dave Burrows. I'm Chief Investment Officer and CEO here at Barometer Capital Management. I want to welcome everybody on the call today. Want to welcome clients. We've got friends of the firm who are on. I think that there's a lot of interest this week, given some of the excitement yesterday around tariffs, which in the end have turned out to be sort of a non-event for now. Lots of interest in strategy going forward. What, if anything's changed in the market? We'll run through all of that kind of as we go. Just starting from really high level, we continue to be in a bull market. We started making new highs in January of 2024, and we're now just over a year in. 2013, and working our way higher. But we made highs in January of 24 after going through the bear market in 2023, and we're basically at highs. Market has been very strong. It's been working its way higher in higher highs and higher lows. When we look at sort of a more near-term picture, you can see a series of higher lows along the way. And as we close today, we're sitting above the 50-day moving average, above the 8-day and the 21-day, above the 150 and 200-day moving average. Market has been marking its way higher. Now, obviously, there's groups that are stronger and groups that are weaker. But internally, I'd note that even though it was kind of a sloppy week last week, again, over the past week, more new highs than new lows. We've been pretty consistently seeing more 20-day highs than 20-day lows, including even on Monday, yesterday, a day that had the potential to be a tough one. So market internals have been pretty strong. And we've talked a little bit about that. I've always found that markets often react the way that they were set up coming into an event. Over the weekend, when we had people questioning, what might happen on Monday, and people asking if they should be selling out their positions, my comment is, look, hold on. This is an event. It's not the only event. There's lots of reasons to have the investments that you have. We're always going to get news thrown at us. We've talked in each of the last number of webcasts about the fact that we are going to have bumpy news flow, and the market is preparing for that. Yesterday, even as there was lots of uncertainty, markets were down. They weren't down all that badly. And frankly, some of the leadership groups, behaved quite well. And certainly, these tariffs are things that we've been thinking about over the last 60 days, and making sure that we were positioned in parts of the market that were likely to be less impacted. So we are in earnings period, and this is a big week. The week of February the 3rd is the biggest week for reporting. We've had a number of the big tech companies reporting, and we've of course had the financial report already. In general, we're working our way toward about a 10% earnings growth quarter for the S&P. That's a reacceleration. We talked about that likely we would see earnings reaccelerate over the course of the year 2025. The earnings surprise data is coming in a little better than 5% ahead of expectation. And that's sort of in the ballpark of what we've seen over the last number of quarters. So earnings in general have not been a surprise. There have been some positives and some negatives, but in general, companies have been beating estimates. Now, seasonality. This can be a period of time where we get some churn, sort of coming out of the inauguration. Very often we get a lot of news flow, tariffs, and a lot of uncertainty around how policy is going to unfold. And that may well be the case. In general, market tends to be strong through the end of May. But you can see that February is sort of a bit of a coin toss. If you go a little further out, March 65% positive, April 71% positive. And of course, that doesn't discern between periods where the market internals are positive, as they are now, versus periods where market internals are weak. So I would say if we overlay periods where market internals are stronger then numbers come in higher than that. Now we look at the NASDAQ. NASDAQ has been not quite as positive. We made a high in early December, and since then we've chopped around a fair bit. We are still above a 50-day moving average. We are above the 8 and 21-day moving average. Maybe we can reaccelerate here. But I do note that the technical internals have not been quite as strong. TSX Composite, frankly, I think a lot of people thought it would be a tough day for Canadian stocks yesterday, and they opened down a couple of percent. They rallied through the course of the day, and of course, there was some more positive news at the end of the day. Our sense has been from the beginning, and we talked about this, that potential tariffs against Canada were more a political motivation than an economic motivation. Our sense was that the border and fentanyl are things that Trump is looking for a win on early days in his presidency. We know the facts are that there is no major trade deficit between Canada and the US. If you take out oil and electricity, which are two things that we provide from Canada to the US because US needs them, the balance of trade is a net surplus for the US 16 years in a row. So now foreign trade is a big part of our GDP. It's about 67% of our GDP, so it's important. Mexico's 73% of GDP, and for the US, it's only 24% of GDP. So it is imbalanced in the importance, but not as lopsided as one would think. So the net of it is the S&P TSX, these are monthly bars, has been generally just slowly working its way higher, and we think that that's a positive. Now, just on earnings growth, we talked a little bit about financials, and financials are a big part of the earnings growth in the fourth quarter, and that helps explain some of the strength in financials. And frankly, it may help explain some of the strength in the TSX because the financials are a much larger part of the TSX index than they are of the S&P. On fixed income, rates have been moving higher since 2020, and we've seen a series of higher lows and higher highs. We've been flirting with highs on yields at about 4.5% on a 10-year bond. That's pointing out that bond investors want to be compensated for the risk that they take to put their money out longer term. And that's why long-term treasury bonds have been selling off now, coming up on 5 years. And so, yes, you're getting a coupon, but when your capital value is falling, not a very attractive investment, and investors have been looking for alternatives to a sovereign debt. Now, high yield bonds relative to investment grade and certainly relative to sovereign bonds have been outperforming. That tells you that bond investors in general are pretty comfortable with credit risk. The fact that stocks are clearly, and regularly outperforming the bond index tells you, this is the asset class that's leading. And when we look at what does well in a more inflationary world, stocks have an ability to raise price. Fixed income is fixed. It's not going higher whether rates go higher or inflation goes higher or not. So stocks are one tool we use to offset a rising cost of living. We focused from an income perspective in dividend growth stocks versus bonds, and they continue to mark their way higher here over the last couple of years. And dividend growth stocks versus high dividend payers also have been outperforming because, again, a rising stream of income offsets a rising cost of living. So nothing changing here. This has been pretty consistent, and we expect it to be consistent going forward. Our income strategies are really chock-a-block full of dividend growth stocks. The other way we hedge against inflation is with commodity exposure, because commodities have a tendency to work their way higher when there's inflation, as we saw in the first big wave of inflation. We've highlighted over the last few weeks that very often, after there is a moderation in inflation, you'll get a second wave, and commodities sort of point in that direction. This is the last 6 months marking their way higher. And some commodities acting better than others. The gold has been the strongest one. We're now about 40% above the 200-week moving average, and this really has been sort of on a tear going back over the last 13, 14 months. We think that it can go on a fair ways. in the last gold bull market. Each leg got to about 80% above the 200-week moving average. We're about 40% above today. And we think both in time, it's been a 13-year cycle versus 25 years starting in 1997. There's a long way for this to go. I know it's an unloved asset, and I know in general, people look at this as an asset that's been disappointing to them over time, but that's what creates the opportunity. Silver also has been breaking out recently over the last 3-4 months. And again, it can move higher a long way above this 200-week moving average, and we're only just beginning. So we think this has some legs. Copper, after coming back and testing the long-term moving averages over the last 4 months, is now marking its way higher. I think it's important to recognize that if you compare the return copper versus gold, it tends to be when manufacturing PMI data is weakening that copper underperforms gold, which it has been doing. But you can see that we're getting a turn higher in manufacturing PMIs. And we think that this is probably an important shift taking place, and one that can lead to some outperformance in copper over the next short while. Crude broke out in January, pulled back to a higher low and turned back higher again. Again, this is something that we've been watching. It's been a bit of a weight on the oil producers. Gas producers have been performing better. And outside of the metals and outside of energy, some of the agricultural commodities have been really strong. Coffee prices more than a double over the last 18 months. So commodities performing pretty well versus bonds. You can see this is a hedge against inflation as opposed to a hedge, which bonds are a hedge against deflation. That appears to be what investors are favoring. And commodities relative to the equally weighted S&P actually has started to outperform. You can see the moving average turning higher, and this is something I think that is not well understood. So the US dollar, just want to touch on the US dollar briefly. We looked at the run up in the US dollar in 2022. Each time relative strength got overbought and was above these bands. It was a near-term high. We talked about the fact that the end of last year, on this very strong run up in the dollar through Trump's election, that it was likely getting overbought. We've now had some more choppy weeks. Spiked yesterday as it looked as though there was going to be tariffs, and came right back down. We also have highlighted that the last Trump administration, US dollar peaked out just around the inauguration, and then started to weaken and weakened all the way through. So there'll be lots of rhetoric, I'm sure, about the dollar and about interest rates, and Trump would like to see both lower. Bitcoin relative to equal weight S&P, it's been consolidating, but in general has been outperforming. And then just quick talk on the Canadian dollar. So as we have a lot of Canadian clients who live in Canadian dollars, we do have some Canadian dollars we take care of. We do probably have more US dollar exposure than we would typically. And we added our global exposure a year ago when we started our global fund. It's notable, right? Yesterday we had a spike lower in the Canadian dollar, very quickly recovered, and now sort of at the top of the last few week range. But we're at a really important point here. Yesterday at the lows, the Canadian dollar was at the lowest point since 2003, 22 years ago. So off this chart. These are weekly bars. So we'll be watching these closely, because a close below this level here would open up a measurement down to the low 60s. Now, if in fact we don't have tariffs, and if in fact they're able to put them off indefinitely, maybe we see the Canadian dollar firm. We do think it's down here because of some of the political turmoil going on in Canada. But certainly the Canadian productivity numbers have been weak, and this is something to consider. So we're watching this closely. This could be a turning point, as it was in the spike lower in 2020 and the spike lower in 2015-16. That was on strong international weakness and strong commodity weakness. We'll see whether stronger commodity prices can be supportive, but just an important inflection point to note. Now, we don't have to be everywhere, so our job is to pick our spots. We're trying to find market leadership. I'm always watching for a change in leadership to see if we need to shift our portfolio structures. And in the event that our breadth data gets negative or the market health weakens, we want to have an ability to play defense. Now, as it is right now, that's not the case. We are quite tactical. The portfolios can change pretty dramatically, but our job is to try to identify parts of the market that are seeing money flow in. And when that happens, the percent of stocks performing well should be expanding. When you go through a healthy market, money spreads to more and more securities within the asset classes benefiting. That's constructive. Expanding breadth is constructive. And so we use our top-down work to try to identify the right markets, geographic areas, asset classes, sectors, and themes that are seeing expanding breadth. And at any given time, some of the areas that we could focus in might be performing well. Given that 70% of return comes from being in the right neighborhood, it's really important to do that work, and we run those models daily. 30% of return comes from finding the right securities to express our view. And the work that we do in this area is aimed at finding companies or securities where we can see the fundamental characteristics are improving, and not just improving, accelerating. And where we see price behaving the way that it should if the fundamental characteristics are improving. If fundamental characteristics are improving and price is not confirming, it may well be there's something out there that we don't know. We don't want anything to do with it. But we start with 60-odd thousand securities daily. We run a series of screens to screen down fundamentally strong, technically strong securities that pass our due diligence, and they become our farm team. And where we can find securities that are in parts of the market we care about, that meet our tests, and they're very quantitative, that's where a portfolio should live. Now, the truth is that a big part of what we do is inventory management. And our key job there is knowing when to carve out positions that are not working as we expected or as we had hoped. And so being a good seller is important. Part of that is recognizing when certain parts of the market we're invested in have started to fail. And what we're looking for there are sectors where we're starting to see deterioration in breadth. And when we see deterioration in breadth, maybe the leader securities continue on. But if the weaklings are starting to peel away, it tells us there isn't enough new money getting invested, there's enough money leaving where risk reward levels have changed. And that causes us to be more cautious, causes us to raise a little cash or tighten up our stops. So over the last few weeks, in general, breadth has steadily been improving. I think part of that has to do with the fact that the earnings picture is brightening. I think part of it has to do with the fact that some of the policies that the new U.S. administration are bringing forward are very business friendly. And so in general, we think that this has been a pretty constructive environment, even though we know we're going to get some inflammatory rhetoric. When we look at the internals as it is today, in general, all of our short and long-term indicators have been improving. Percent of stocks above the 50-day moving average expanding. Percent of stocks with positive weekly momentum expanding. Percent of stocks making new highs versus those making new lows. We talked about that earlier, expanding. And the percent of stocks trading above their 150-day moving average expanding. So we're giving things the benefit of the doubt from a market backdrop perspective. From a leadership perspective, not a lot of change. Financials continue to be leadership. We're trading right at the highs. Now, this is an ETF made up of banks, insurance companies, credit card companies, exchanges, fintech. But we came out of a long period of underperformance, 2007 through 21. The group broke out and then consolidated while the Fed and other central banks tightened rates. And before the rate tightening was over, these started to lift. And there's nothing changing here. JP Morgan made a new closing high today and a new relative strength high. Goldman Sachs, not a new closing high, but relative strength is right at the highs, better than 91% of companies over the last 52 weeks. and this relative strength line is steadily improving, trading above all the moving averages. When we look at the card companies, not that long ago we added a position in Visa. Look at this move from the end of the year through now, $303 to $345, up 15% in the first month of the year. That's consumer spending. And look at the TMX group. So this is the exchange here in Canada. It's been a big data play. The expectation is there's going to be lots of financings to get done this year. But boy, they just knocked the cover off the ball from an earnings perspective. Stock was up 8% today. So we're getting lots of positive surprises in financials. The Canadian banks were a little weaker yesterday and today, off some, but still we've got a rising relative strength line. We'll watch that closely. But even with the concern about the Canadian economy and tariffs yesterday, we came down to support, closed halfway up in the range, and we continue to be above support. And that's the same for the majority of Canadian banks. So financials in general, I think, continue to be a great weight in the portfolio. 35% of Barometer's assets are in financials, and they benefit in an inflationary world. Industrials have been leading really since 2023. They made lows well before the market low in October of 22, and have been on a relative basis outperforming. We've talked about some of the names, but in general, they continue to see rising relative strength. Materials corrected through December, came down to the long-term moving averages and have been moving higher over the last 4 weeks. But in particular, gold stocks are on fire. Now, I've said many times, I'm not a gold bug, but there's a time and a place. And the price that they're selling the gold they're producing at versus their cost of production means their cash flow this year is likely to explode. For 2024, in the case of Kinross, it looks like their earnings will be up about 130% year over year. And I'm going to guess that the estimates for 25 are going to have to go higher because certainly gold is running ahead of most analysts' estimates. Agnico Eagle is very similar, very strong cash flow generator, pays a 1.7% dividend, been growing its dividend over the last three years by 20% a year, trading better than 91% of companies in the S&P. Alamos Gold is another that we continue to hold. So we really like this sector. It's a difficult sector. You have to focus on the companies that are really strong operators because costs can be an issue. Oil prices have been sort of stagnant, so that's good for them because the energy cost is a big component. But in general, it looks as though gold price is going higher, and these are operators that have done a really good job of executing. Moving on, if you look at the long-term picture of Agnico, this is kind of what I'm talking about. The last bull market, Agnico was up 1,800%. And that was between 1999 and 2008. These cycles go on a long time. This is a relatively new cycle. We think that there's lots of room to run. And this is a company with 41 years of making dividend payments and been buying back shares regularly. Energy. Energy continues to kind of consolidate. It's been a little frustrating. You've got to pick your spots. Certainly the gas producers and gas transporters have been leading. Cheniere is one of our big positions, selling liquefied natural gas overseas. CNQ has been consolidating over the last few months, but again, we think it's early days in the bull market. Last bull market, CNQ was up 700% between 2003 and 2008. And that was post the bear market that ended in 2003. This bear market ended in 2021, and we think that we're early days and there's a long way to go. Stocks up about 100% at the highs off the breakout, and we'll see where we go from here. Consumer discretionary. So this is a group that turned higher in the summer. We talked a little bit about that. Of course, our big positions have been Amazon and Costco. The broadline retailers, sort of diversified retailers, have had great relative strength. Amazon made a new high today, relative and absolute. closed here at $242. It's trading above a 5-year high. Costco, same thing, new high today, broke out above the high from December. Again, this is after a relatively sloppy week in the US market, but you can see that the combination of the card companies and the biggest retailers are showing you that the consumer is actually probably in better shape than we thought. Travel and leisure has been a sector that's been leading. This is the PEJ ETF. It's made up of some of the communications companies and some of the consumer discretionary suppliers like Expedia and Warner Brothers, Royal Caribbean, DoorDash. It's made a new absolute high over the past week and a new relative strength high. And we added a new position a couple of weeks ago, Cheesecake Factory. This is a company that continues to grow units organically. It's a complex business. They've done a great job of executing. There's got lots of new locations, and the U.S. consumer seems willing to spend money on this type of restaurant. It's one that's doing particularly well. The one area of consumer we've been sort of careful on is the home builders. They had been leading until sort of the fall of last year. On a relative basis, they've been underperforming, and this is a group that we're currently avoiding. Communications made a new high today. Communications used to be telecom, which of course it's not today. If we break it out into the big communication platforms, Meta made a 5-year high, made a relative high, made an all-time high. Netflix has been doing the same thing again today, another new high. And Google reported tonight. We'll see how Google did. It looks like it's down a little bit, down about 5% post the earnings. I'll have to see how the earnings came in, but looks like they've missed by a little bit. So this has been a group. Now, 5% pullback pulls it right back to $200, a little bit below. And frankly, it would have to move down to, about $180 to break the stock down technically. So we'll see what they have to say on the conference call. Healthcare is a sector that had underperformed for quite some time. You can see weak relative performance into December of this year. Last couple of weeks, we've talked about the fact that we've seen some improvement here. In particular, we're seeing improvement in medical devices. Companies like Intuitive Surgical and Stryker and Medtronic. So it's a group that we're taking a harder look at. That is some positive change. And on the other side, technology kind of continues to wane. The relative highs were back in July of last year. And relative performance has been weak. Now, there have been some great performers in the group, but there have been some weak ones. The thing that we keep getting back from clients is, well, these companies like Apple and Microsoft and Broadcom, which we do own, are great companies. We don't want to miss some of these great companies. But frankly, there's other leadership in the market. Financials have been outperforming. Even European banks have been outperforming the Magnificent Seven since January of 23. So when technology makes a new relative low versus the S&P after peaking 6 months before, we take notice. And we've been underweight the group over the last number of months. Now, internally, cybersecurities continue to behave pretty well. Software as a group is behaving pretty well. We talked about HubSpot last week. Semiconductors on the other side have been the weakling. We have the one holding left, and that's Broadcom. They're hanging in pretty well. We'll see what happens when NVIDIA reports their numbers, but in general, the group is really underperforming. Flows have been out of healthcare for 2 years, and they've been into tech. Let's see if maybe this gap closes a little bit. Groups that are defensive aren't showing any real strength. This tells us that investors are still, in general, leaning toward risk. Utilities are relatively underperforming. REITs are relatively underperforming. Consumer staples are underperforming. So it's a risk-on market versus risk-off. Last couple of points. This chart continues to develop. I think it's an odd one. Gold is outperforming and has been now for the last 12 months versus semiconductors. That's a change. That's something that you have to recognize. We have 3 gold positions. We have 1 semiconductor position. three market leaders on the gold side, one leader on the semi side. It's been a while since we were weighted that way, but you got to recognize these change points. Just finally, from a sector perspective, you can see that breadth was down about 1.5% on the week. The groups with the strongest breadth here to the right, largely financials, with some other groups, oil and oil service. You can see there's been some weakness in aerospace and machinery. We take note of that. You know, our weight in industrials is a little bit lower. On the other end of the spectrum, we've got things like, you know, the consumer staples companies, the food companies, semiconductors, the builders, which we talked about. Transports have been a little weaker. Some improvement in biotech, drugs, and healthcare. This causes us to spend a little bit more time looking at this group. And, you know, of course, we're always in transition. Software continues to be strong. Precious metals is improving. So here's how it lays out. Financials continue to be the biggest weight in the portfolio. Energy is about a 16% weight. A lot of that is energy infrastructure that continues to perform well. Clearly, energy is important to the US. The proposed tariff was only 10%, a lot better than 25%. And in the end, we thought probably there would be a carve out for energy, which we didn't have to get to. We continue to be really light on utilities, real estate. Healthcare is one that we're bumped up a little bit. We could bump up some more. Consumer discretionary, we've been raising. And technology continues to be a very lightweight in the portfolio. So in general, I think we can continue to lean toward risk, things that can give us inflation protection. We're not seeing any concern in credit spreads. Bond investors are comfortable with the risk that they're taking from a credit perspective. High yield is outperforming investment grade. Volatility is within the range that we would hope that it would stay in a solid cyclical bull market for stocks. And we're really only about 14 months into what is likely 2 to 3 years of a cyclical bull market. So market got tested yesterday, and I think it passed pretty well. It wasn't until the end of the day, after market hours, that we were told that there was a near-term deal. Markets were down. They weren't down too badly. And the leadership groups actually held their own very, very well. We'll watch for signs of weakness. We think we're positioned really well in the event that there are tariffs, but it doesn't look like we're going to face them in the near term. The truth is, to try and trade around a news event is a really risky proposition. We think we have great companies, and they're in sectors that clearly have a lot of sponsorship. So if things get weaker, we'll get more defensive. It's what we do. But in the meantime, portfolios, I think, are pretty well positioned. Maybe we'll add a little bit of healthcare over the next little bit. Consumer seems to be in good shape. And a weaker US dollar would be helpful for a lot of the themes that we're focused on. So we'll see. With that, happy to take any questions. Let's see what we got. Okay, question here on the private equity firms like KKR and Apollo. You know, it's interesting. We've been many years now where investors, big institutions and individuals have been pushing money into private investments. And I think a lot of the reason is that there's not as much compliance. There's not day-to-day marking to market. And as a result, even though certainly prices are moving around, they don't see it in their portfolios. We think that there should be a premium for liquidity. We prefer to focus more in liquid assets. Now, we do have our music fund, and the music fund has been very, very consistent, has no debt. But a lot of private equity firms use a lot of debt to take an asset and lever it up and get a financial return. I think some private equity firms are having a hard time getting exits on some of their positions. So if the window opens this year for new issues, I think there's a lot of issuance that can get done because there's a lot of private equity firms that would like to see some liquidity on some of their investments. But we're less interested in being invested in private equity companies. A lot of them have a lot of real estate exposure, and we think real estate is sort of problematic. Question from Steve: do you see a comeback in Canadian energy sector when the tariff story finally ends? I think actually the Canadian energy stocks held in remarkably well. I put up that chart of the equal weight Canadian energy sector. Frankly, it's moved sideways over the last couple of months. If we really thought there was a problem from tariffs, you would have expected the stocks to really get hurt. And within the long-term trends, companies like Suncor and Imperial and CNQ, they pulled back some, but they're sort of within their series of higher highs and higher lows on the long-term chart. So I think they continue to look constructive. The gas stocks look probably more constructive, and the infrastructure companies look even more constructive. Lawrence is asking, what might be some ways to profit on the weak Canadian dollar compared to USD? Well, certainly, the Canadian energy companies do very well with a weak dollar. They're selling in US dollars and they're bringing it back to Canada with a cheap dollar. So that certainly doesn't hurt. There's a lot of manufacturers that can benefit with a weak dollar. A lot of the materials companies can benefit from a weak dollar. I wouldn't right now be taking Canadian dollars and buying US dollars, expecting the Canadian dollar to weaken a ton more, not unless I saw the Canadian dollar breaking those support levels that we talked about. So we'll see. But we do hold, foreign currency assets, both in our global fund and in our US holdings, to get some diversification. I think the most important thing right now is to be balanced, not to be out over your skis on currency, not to be out over your skis from a sector perspective, not to be out over your skis, one theme versus another. We want to be able to take whatever comes at us because there is going to be some news flow. Last one, there seem to be several key growth drivers emerging in Canada. Low Canadian dollar, comparatively lower rates, continued free trade emphasis. Are you starting to evaluate investing more into Canadian stocks as a result? I think that we have pretty good exposure as it stands. Our key exposures would be in energy and financials. We have a little bit of industrial weight. We have very little consumer weight outside of Loblaws and Dollarama. I think those are the sectors that we would want to focus on. Energy, materials, financials. Yeah, that's sort of where we are right now. What we are doing is we're expanding our exposure to global stocks. The global fund that we launched a year ago was up 29% versus the global index up 6%. It's up about 7% so far in the first 5 weeks of the year. I think there's a lot of value in global markets, especially in financials and industrials, which are strong sectors. So that's kind of how we're trying to take advantage of things. And the last question was, what are your thoughts on Global X robotics? Well, there's a couple of ETFs that are focused on robotics and artificial intelligence. BOTZ, B-O-T-Z is one of them. ARKX, I believe, is artificial intelligence and robotics. Both are performing very well. So I think that obviously that's a theme that we want to continue to be taking a look at. We own that in our macro fund. I think that's it. I think we answered all the questions. If you've got questions that we haven't answered, shoot us a message or give me a call. Happy to jump on the line and talk. If there's things you're worried about that we haven't covered, I'm happy to have a conversation. Our job is to keep on talking to more people, and we're doing that. So appreciate you joining us on our Tuesday calls, and we'll see you again next Tuesday. Everyone have a great week.